young people, they're actually quite nice places to work because they are less maybe organizationally heavy and bureaucratic than large organizations. The downside, of course, if you're taking an entry-level position in one of these, is that maybe the training is not that structured, right? You don't get as much regular upgrades of your professional capabilities as you would at a place like Coutts or JP Morgan or a private bank like that. UBS has got excellent internal training. Okay, so advice to families is a growing part of the wealth management business, and it turns out that many are taking it outside the big banks. They want a more personalized service. They want to feel that their money is actually being managed by the people sitting across from them rather than an investment team in some faraway location where a CIO is setting strategy for the whole bank. You know, they want that kind of personal boutique access. Some family offices don't do any money management, right? Because family office is kind of a generic term. Some just do sort of family admin, right? But the kinds that I'm talking about are the ones that actually take a role in financial management. It's a very rapidly growing growth area, this, and technology is making it easier and easier to do, because what many of these banks will do, these multifamily offices will do, is they'll take the family's money, they will custody the assets. Everybody know what custodying the assets is? They will keep them somewhere else, but have the authority to run the account and do the risk analysis and provide the statements. So you're custodying it at a big bank like a Julius Baer or Credit Suisse or a UBS or a Barclays, but then your family will be, and you'll allocate the assets in line with what your family tells you they want, and then every month you'll provide them consolidated reporting, tell them how it's doing, do a bit of risk analysis, show them what's worked, what hasn't worked, and it's a very interesting business model that is actually currently growing very rapidly. And people are having a lot of success with it. They're finding that even smaller clients at big private banks are saying, you know, we don't need all of the hassle of working with a large organization. We prefer to work with you. You're giving us similar sorts of advice on diversification, and you may be able to do it cheaper without that organizational overhead. So it's becoming increasingly popular. Okay, I want to talk about a few threats to wealth, talk a bit about succession planning, talk about what a credible offering in wealth management looks like and what you must know in order to be a credible wealth manager. And then we'll gently get to the end. So, yeah, succession planning is obviously a very important aspect of, sorry, no. Right, let's talk about threats to wealth, first of all. I've covered many of these already, but let's just go through them, right? Now, in Western Europe, with the notable exception of Chechnya and all of the stuff that was Eastern Europe, you could argue. But, you know, war is not something we worry about very much in most developed countries. But, you know, these things are important issues in developing economies, right? Historically, all of these things have been a big issue for wealth preservation. And that's why diversification, international diversification, is a pretty good thing. Inflation. I haven't really explicitly discussed this before. I may have mentioned it before. But, you know, it's very important when you have a wealth management plan that you're focusing on preserving the real value of what you have, right? Because preserving the nominal value is not good enough. If you've got $100 and inflation is 20%, then, you know, next year your real wealth is down by 20%. Okay, so at a minimum, you have to protect for inflation. But what is the CPI? The CPI, I think I mentioned this briefly a couple of weeks ago, but the CPI is a generalized measure of inflation, right? It's a basket of goods that is the average consumer, if there is such a thing, consumes. Now, many families will have a basket of consumption that is significantly different from what, you know, everybody else consumes. And so if they've got a particularly skewed pattern of income distribution, if they've got, you know, 15 children in the family that need to be educated in expensive universities in the US, then the inflation rate that applies is not the inflation rate of the country where they live, but the cost of meeting those obligations in dollars in the future. In general, you need to be a bit sensitive to both beating inflation. Obviously, it's a good thing to preserve the real value of your wealth, but also about the particular factors that affect an individual family. Taxation is very important. If you can structure your affairs in a way to minimize your long-term taxes, that's a good thing. It's becoming less popular now with governments. Aggressive tax planning is not viewed very favorably by many governments because they need the money. But of course, if you're managing wealth, one of the threats to your wealth is taxation. In some countries, it's as simple as the government turning up and confiscating your property. It does happen, right? You get expropriation, you get nationalization. It happens unexpectedly. It happened a lot in Western Europe. Governments took over companies, and all of a sudden you had no choice. Now the trend in Western countries is the other way around. They are selling off public assets on the grounds that they'll be better managed by the private sector. But it's a relevant thing to worry about. Family feuds, well, nobody can control for this. It happens. It's a great way to destroy wealth, is to start fighting with each other and spend a lot of time in court. Divorce is also a great way to destroy wealth, very expensive court proceedings. You'll see London has now become the divorce capital of the world because they have very favorable treatment here in terms of distribution of marital assets. But it's a very expensive thing to do. There's some high-profile cases recently where there have been some very big divorce cases. You were talking about finding clients. Well, one very good way to find clients is to find people after divorces who come into a lot of money and need help managing it, right? Good way to destroy your wealth is to have no plan. You just leave it in cash. You don't care about the taxation. Bad idea. You'll get taxed. Inflation will erode the value. You need to have a plan. If you risk manage poorly, if you take your concentrated family wealth and put it into a single stock, you might be lucky and put it into Apple, or you might be unlucky and put it into something that goes bankrupt. Succession planning, same thing. If you don't plan for inheritance taxation, then you can be in great trouble. So look, I think that the way to think about this for many family businesses is to say our risk capital, our highly risk capital, is in the family business. Our preservation capital, and what I mean by risk capital is the thing that can make you 2, 4, 6, 8 times your money. This doesn't happen in the textbooks, right? It happens if you're creating your own business and driving the value in that business. So that's what I would call a risk pool. And then on the other side is you have this preservation pool that is managed properly by a wealth manager. People have many different approaches to succession planning. One reason why people save a lot, and actually go back to my earlier example here, right? This is how things become relevant across different things. So if I go back to this example here, right? So this is the valuation of a house. This is the cash flow, and this is R minus G. But supposing you have an absolute desire to give this to your grandchildren, right? Then none of this matters in a sense. You don't care. You're not going to be enjoying the assets because you have a life expectancy of 10 or 15 years, but you're desperate to hang on to it because you have a bequest motive. And thinking about that and how you manage your assets with respect to that bequest motive may mean that you do things that the models don't readily predict. So if you really want to leave everything to your children, and in particular if they're real assets, you may not care about the value of them, you just want to hand them on to your children or grandchildren. And this is where sort of non-economic factors become important, both in asset valuation, right? Because they've got an intrinsic value that is outside the short-term ability to earn a return from them. Art is a very good example. People have big art collections that they don't view as part of their estate, but they've got this big bequest motive. They want to hand it on either to their children or in many cases to a museum, and they will set aside some money for that. And later on in the course, I may talk a bit about art and wine and cars as alternative asset classes, which people sometimes do. And clearly you can succession plan in many different ways. You can leave behind the business. I've told you some of the issues with doing that. If you really care about your children, you should probably leave them a business plus a bit of wealth on the side that is properly managed, just in case the business goes bust. And increasingly, people are leaving nothing. I told you what this is called, right? It's called skiing, or spending the kids' inheritance. So if you've got an objective that says, I want to leave future generations nothing, then that will be a different plan that you will need to put into place. I think Warren Buffett has famously said that he's going to give his children a house and maybe nothing else, or very limited amounts of money. And I think that there was some other famous philanthropists that did the same thing, right? They set their children up with a basic minimum for a reasonable lifestyle, but then they give all their money away to charity. They think that improves incentives for the next generation. Obviously a very personal choice. The point of going through all of this is that an important part of what you do as a wealth advisor or manager, obviously a lot of it is about intertemporal decisions, but there is a whole lot that goes on with respect to people's preferences for what happens after they've gone, which is hard to capture in a normal framework, right? Where you've got everything ending at big T. But my point here is that you have to you have to sort of acknowledge that and build that into your plan when you're actually giving advice. And as I said, the second half of this lecture course is actually about that giving advice in the real world, right? There's the theory, but there's also the business of actually sitting across an individual or a group of people and making the theoretical insights operational to what they're trying to achieve. Okay, what do you need as a credible wealth advisor? Well, I told you that the biggest question that I got asked was what's happening to Apple? And so, at a minimum, to be an efficient wealth advisor, you do need to have quite substantial, quite detailed market knowledge. Either you do it yourself or you have access to it. So if you're a small family office, 3 men in an office in Mayfair, or women, then you need to make sure that you have banks and other institutions where you're custodying your assets, or where you have some sort of relationship where you can get access to what's going on in the market. Without some knowledge of the financial market landscape, hopefully a very detailed knowledge of the financial market landscape, it's very difficult to give people advice. So you need financial market expertise. You need to understand all the risks of investing, both the explicit risks and sometimes the hidden or occult risks of investing in things, right? So for example, in a fund, and we'll get to this a bit more later on, if there's a hedge fund, for example, that you've invested in, and you've suddenly seen that the principal owner of that hedge fund has suddenly decided to buy a private jet and a private yacht and is spending a lot of money on luxury consumption, you might conclude that their interests in managing money are a bit diminished from what they were. And that's kind of a hidden risk of investing, right? The motivation of the people that you're giving your money to manage. Practical thing that happens. Many private banks will have something called an advisory offering. An advisory offering is built up exactly to advise people on single stock ideas and positions. We've all said and agreed, and in our finance theory, you've learned that diversification is a good thing. Doesn't stop people from trying to build up individual stock portfolios where they have an idea, they like the story, they think they can beat the market, right? So it's quite important as a financial advisor to have a view on single line stocks. You may not recommend that people do this, but whether you like it or not, there is a big demand for this kind of service, right? And many of the big private banks will have desks of people that are in the capital markets every day buying and selling stocks, individual stocks and bonds on behalf of their clients, such that if one of your very wealthy clients calls up and says, I see that Facebook is down 5% today, there's somebody there who knows what's going on and will be able to give you advice on it, right? It's pretty important to be quite well versed in single line stocks in a credible wealth management business. Discretionary offering is obvious. What's a discretionary offering? A discretionary offering is where a client comes to you and says, Mr. Banker or Ms. Banker, here's $100 million. Please run it for me, right? I'm giving you complete discretion over how to run this portfolio. I will tell you my risk and return expectations, and I want you to manage it to that, but I'm giving you discretion. As soon as a client gives you discretion as a banker, it's your problem, right? You own the performance, right? Because you have taken on an investment mandate from a client. They've given you a letter outlining their preferences in terms of risk and return, what you can and cannot invest in, and it's your job then to deliver them a return, okay? That's a discretionary offering, as opposed to an advisory offering where the client calls you up and says, I like Facebook, what do you think? You say, yes, it seems like a good idea. We think it's a buy. And the client then says, okay, I'm buying. Now, the regulations around that advisory business have become much tighter. In the old days, it was the client's liabilities. If I called up my bank, and my banker says to me, I'm buying Apple, what do you think? And the advisor says, yeah, we think it's a fine idea. And I then buy Apple, the risk was a lot on me. The regulators are now trying to make it more of the bank's problem when they give advice. So they're being quite prescriptive about what you can and cannot say to an individual when you give them advice on a single stock. And the amount of documentation that you require now to prove that you've given good advice to the client is becoming very heavy. And it's interesting that the regulator is acting in the way, is helping finance theory, right? So what it's saying is that individual people typically should not dabble in stocks because A, it's a very difficult game, B, we know that diversification is better, and C, there are people with bigger research budgets than you that can maybe do a better job of buying individual stocks. So the regulator is stepping into the act and saying, we don't think that this is something individuals should really be doing, so we are going to make it harder. And the regulator's got that idea from all of us in the finance teaching and theory profession that says, you know, in general, it's not a good idea for individuals to be trading stocks because it's bloody hard and it's very difficult to achieve a satisfactory return if you're trading them. So the regulator is getting onto that and saying, well, look, if you are going to do an advisory offering, let's make sure that you give the advice very carefully. Let's make sure that it's suitable for the client. And let's make sure that you're not doing it just to make money out of the client, right? And this is another very important point that you won't hear in any other course in Imperial, this whole notion of conflicts of interest in finance. You may actually hear about it because it's the basis of many theoretical microeconomics courses about conflicts of interest and principal agent problems, they call them. But it's becoming a very big deal in investment management, right? This conflict of interest point, and I'll talk a bit more about that. So the discretionary offering broadly is me as a banker going to a client and saying, give me your money, and I will use everything I've learned from theory, and I will construct you a efficiently managed diversified portfolio, and furthermore, I'll do it cheaply, right? If you did it yourself, you'd have to go out and buy the stocks, pay the transaction costs, you'd have to pay a custody fee. I can do that for you in an economical and efficient way, and therefore you should give me your money to manage. Now, how do you evaluate a discretionary offering? If you're a client and you're going to a bank and somebody says, give me your money to manage, what would you ask them for? What's the first thing you'd say to them? Yeah, very good. Who said that? Excellent. You'd want some sense of their track record, right? We all know that past performance is no guide to future performance. But if you're handing over your money to a group of people to run for you on a so-called discretionary basis, where they will be charging you a fee for that, you want to know that they have the basis to earn that fee, right? That they know how to do this, that they are present in the markets, that they understand how to build a diversified portfolio, that they can report the returns to you. And then, of course, the most subtle thing, that you can trust them not to run off with your cash, right? And actually, because of the difficulty and some banks do this, right? Some banks have long track records of discretionary performance on behalf of their clients that is pretty good, right? They've stayed out of trouble, they've done better, you know, they're in the top quartile. There are people who evaluate banks regularly. They've been in the top quartile of their relative benchmarks and have done a pretty good job. But it's a very hard thing to do, to get somebody to trust you to give you a discretionary mandate. And obviously your track record has got to be good, your systems have to be good, your knowledge has to be good, you have to appear to be competent and professional and credible, and clients will have to believe that their money is safe with you before they hand it over to you, right? And you know, I referred to this earlier, there is a large class of highly fascinating theoretical work on something called principal-agent problems, and it's really highly theoretical. When I went into my first class on this in graduate school a long time ago, I thought I was in a maths class because the mathematics is very complicated, and it was topology and correspondences and all sorts of fun stuff. But the basic insight behind the principal-agent problem is that when you as a principal employ an agent to act on your behalf, the agent, instead of acting on your behalf, might start acting in their own behalf, right? You get this a lot in corporate governance, for example, where you have an ownership group of the company, which are the shareholders that are represented by a board of directors, but you've got a CEO that wants to have a private jet and a big corner office, right? Principal-agent problem. You're a principal, you appoint an agent, the agent does things for the agent rather than for the principal. Obviously, a big risk in discretionary asset management. I'm giving you my money to manage. I'm paying you a fee for it. You're working to maximize the fee rather than the return to me, right? Central problem, conflict problem in finance, right? When you delegate the authority of investment management to somebody else, you've got a problem in controlling the behavior of that agent. The regulators are trying to do this, trying to control the behavior of the agent by making it very difficult for bankers to act in their own interests and not in the client's interests, but it is a big thrust and a focus of regulation. Now, it also means that the incentives to manage risk, particularly in a hedge fund context, where the hedge fund manager, we'll talk more about hedge fund compensation schemes later on, but if you're giving somebody money and they get paid when they make you a return, so if there is a performance fee, they may have an incentive to take too much risk with your money, right? I'm a hedge fund manager, you're a wealthy individual, you come to me, you say, manage this money, I'll give you a return that is based, I'll pay you a fee that is based on the return. You get all of the upside, the client gets all of the downside. If they lose all of their money, you've lost a client, they've lost their money. If the thing goes up a lot and if you have a performance fee attached to it, then you may have an incentive to take on too much risk. So you need to make sure that the point behind this is, in order to have a credible offering in wealth management, you have to cover all of these things. You have to have the right fee structure, you have to have the right people, you've got to have the right track record, and you've got to be pretty honest about what you can deliver and what you cannot, right? So if you're offering, a return with a Sharpe ratio of 3 or something ridiculous, you're not allowed to make that promise from a regulatory perspective, but you're going to disappoint the client's expectations with what you can actually deliver. So it's very important to be quite honest and calibrate this quite carefully, right? And you have a whole host of data that tells you what you can achieve in the market. So many banks these days will have a projected rate of return for a balanced portfolio. So you go into them and you say, I want you to diversify my wealth. I would like a balanced portfolio, 50% stocks, 50% bonds. Tell me what I can expect to earn. And many banks will have a view on that. So they'll say that the expected return on stocks over the next 10 years is, let's call it 4.5% to 5%. The expected return on bonds is, let's call it 3%. We'll combine that in a portfolio for you. Your overall return will be something like 4.5. But by combining it with bonds, we would have significantly lowered your expected risk. Your Sharpe ratio will get better. That's the kind of conversation that a bank will need to have with their client as they are selling a discretionary asset offering. And as I said, it all comes back to what you've learned here, right? Portfolio construction. Okay, what are the challenges when you are trying to convince somebody to diversify? Well, if you're Tim Cook and you're sitting in Cupertino in California, you know what the address of the Apple office is? Yeah, very good. It's quite cool, I thought. I took a picture of it when I was there. It's called One Infinite Loop. But in any case, when Tim Cook is sitting in his office in Cupertino, it's very easy for him just to run the company and enjoy his Apple stock, right? I don't know why I'm picking on poor Tim Cook, but I quite like Apple. But it's quite easy. It's inertia. The stock's there, it's going up. You have this, on paper, you've got a massive holding. You don't feel as if you need to do anything. So as an advisor, you're often competing with inertia. Do nothing is quite an attractive option for some people. You're competing with a lack of financial knowledge. Many people don't understand why diversification is a good thing. They don't understand the distinction between exogenous risk that can hit you from nowhere and endogenous risk. They don't understand the difference between idiosyncratic and diversifiable risk, right? There is another class of people that are genuinely too rich to care. They've put aside enough money and they've got enough in stock such that it would take an absolute catastrophe for them to become poor, right? Bill Gates is probably a good example of this, Warren Buffett. But even at lower levels of wealth, you will come across people who say, well, look, I don't really care, right? My needs are taken care of for the foreseeable future. I don't really see a problem with this. It's still your job as a responsible wealth advisor to point out to them that even though they may have a very small marginal utility of extra return, efficiency is also important. They're taking risk, they should take it efficiently. Many people, we've talked about this before, think that they can control their own risk. You know, you've heard the notion that investment bankers used to think that they were masters of the universe. Well, actually, a lot of entrepreneurs do think that. They believe that they can control the risks of their companies. They don't understand this notion of risk. And then the other thing that I found really quite incredible is that people would come in and want to run a portfolio like they run a business, right? So one particular gentleman thought that by him, that buying a stock and expecting it to go up was the same as hiring an employee and telling them to work harder, right? There was a totally mistaken belief in their ability to just control that. So there is a sort of framing issue that comes in. You've run a business, everybody tells you everybody does what you tell them to, and then all of a sudden you're confronted with a stock portfolio, and it's not so easy to tell Apple stock to go up, right? There is a really mistaken belief in people's notion that they can actually control a stock portfolio, which leads them in the direction of over-concentration, right? So typically, my entrepreneur clients would come in and say, I read the papers, I'm smart, my family are all highly educated, we all read the papers, and we would like you to buy Facebook, Amazon, Apple, Netflix, Google, and stop there, right? Hard conversation to have because they've read the papers, they think they understand risk, they think they can control it, they don't understand the value of diversification. Where it gets very difficult is when these stocks go up 50% a year for 3 years, and you start feeling a little bit foolish, right? Because you've said diversify, and they wanted to buy all of this stuff, and it's gone up significantly. It's a problem. It is still the right advice to say diversify. And we've talked about exogenous risk versus endogenous risk. Okay, so I've done a lot of this in what we've done today in terms of speaking about a client with a concentrated public stock position, a client with all of her wealth in a single private business, single listed business that she owns, and someone who has come into a large amount of money through inheritance, divorce, etc. I think what I'm trying to get across to you here is that people who have either single stocks or single businesses will often think that they are taking very significant steps towards diversification when actually they're not, right? So let's take an example of Facebook. Mark Zuckerberg. Somebody's been beating him up about the need to diversify. So he goes out and buys WhatsApp. WhatsApp is owned by Facebook, right? And he thinks he's diversified. What do you think? Is he actually diversifying? Well, he is a bit, but really this is far from ideal because you're still in the same sector. You're still in technology. You're still in Silicon Valley. And even buying Instagram or Snapchat or whatever else he's bought, doesn't make much difference. So diversifying lines of business is not the same as efficient market diversification. Similarly, with my owner of a, iron ore mine in Chile, right? You advise him, say, get rid of this mine, do something else. He says, guess what? I'm getting very diversified. I'm buying a copper mine in addition to my iron ore mine. Doesn't help. It's not diversification. It looks like diversification, but it's not diversification in an efficient markets, capital market sense. Yep.
I'm curious about this kind of mentality when you convince them to purchase.
Invest into your competitor's company so that you hedge the risk of your own company fails and your competitors rises.
Yeah. So that's a very interesting set of observations, right? So you own an iron ore mine. Are you supposed to buy shares in your neighbor's copper mine to diversify your risk? It doesn't do much for you. In effect, what you're saying is buy other people's businesses, right? But buying somebody else's copper mine just exposes you to another set of idiosyncratic risks. It may be uncorrelated with yours, which is a good thing, but it's really not enough because both of you are subject to the same, very similar patterns of exogenous risk. If you're in the same country, you have government risk in the same country. You're both linked to the commodity markets. My point is, if you're the owner of a single business or a single stock, and you try and diversify by buying other businesses or buying other stocks, it's a baby step towards proper diversification. But actually the best thing you can do is sell down some of your position. How much is a matter of debate, and then invest that in a properly diversified stock and bond portfolio. That's what all of the theory will tell you. As I said, it's a very hard conversation to